Okay, good evening, everyone. Thank you for showing up again for the third part of order flow, reading the market by the order flow. I see most of you were in the past webinars before, so thank you for coming back and being eager to learn more about this. Um, Beautiful concept, which is very um, effective for trading, simple for analysis, um, and I think the most professional way to understand what's going on in the market. So let's begin today's session. Okay, so just about me, my name is Gil Ben-Hur, and I'm trading currencies since 2007. Around 2012, 11, and 12, was introduced to supply and demand and order flow concepts. Since then, the market suddenly started to make sense to me. It was no longer random, and I was starting to make profits um, in the forex market. Um, in the past 2 years, I've been developing a trading fund called the 5% Trading Fund. What we're actually doing is we're looking for good traders around the world and providing them fully funded accounts to trade for our fund, and we split the profits. The fund takes all the risk for possible losses and bring all the capitals for the trading, and the trader just provide his talent and the hard work of trading. And we also provide amazing growth plan. This is a few things about what we are doing in the 5%ers trading fund. Um, we fully found experienced forex traders and also intermediate traders. We have opportunities for them as well. We provide the capital, the trader provide the talent and the skill, and we both split the profits. We pay every month, and unquestionable, and we provide unparalleled growth scheme where we actually double the capital trading for us for every 10%. It's nothing that a retail trader can do in his own account. So the growth is actually exponential. You can go up to $1.4 million account in just 7 rounds of doubling. Do the math yourself. um, we provide a great opportunity for forex traders, whether they are very experienced traders or even at the very early stages of trading. We provide high capital to trade for traders. We supply the capital. You don't need to bring anything from your own. You don't need to risk your own money when you're trading for us. It's a 100% account financing program. We split 50% of the profits. As I said before, we bring the capital, you bring the talent, we split. And we provide double for every 10% growth plan. And you can grow your account in 7 rounds up to $1.4 million trading account. In order for you to get qualified, we have to test you. We do it over a live trading account, which we call it a take profit evaluation account. And this account, it's a real live money account. You trade on this, and whatever profits you make, you'll get your 50% share right on the start. Everyone can apply and being accepted to trade evaluation account, and there is a tiny cost as it's a 4% of the capital that we provide, and these 4% are the only 4% that we also allow for the evaluated trader to lose. So that's how we protect our capital. But you actually get to trade a $10,000 account for only 400. It's not a broker account. It's account that us, the fund, are providing for you. Anyway, you can get all the information on our website, which is under the below on the slides, and we also provide. We also have a referral, a trader program, because we are looking for good talents from all over the world. If you know any trader or any community of traders that may be can be benefited from our program, please refer them to us, and we will reward you in instant cash the same minute that they place their application with us. So you can go to our site, read all about this. Please help us find traders, and if you're a trader, you're welcome to join us as well. Okay, what we're going to do today, what are we going to learn today? So we'll recap about the past topics that we're discussing in the past 2 weeks, about supply demand, about the order flow, about how to observe the charts, and to try to find where are the buyers or the sellers are waiting to enter the market. And the next thing we'll go through new stuff, which I called it implied order flow, meaning that not everything is being seen. Sometimes you need to imply and just recalculate what you see, and then decide and then understand things on the market. And I'll show you how that works. It's pretty simple. Don't be afraid of that. And we're also going to talk about the fingerprints of the big sharks, the big fish, or the big money, whatever you want to call them. When they enter the market, there are significant signs that they are interested in a certain direction in the market, and we can see it. I'll show you the very basics of that, and it's a powerful tool in its basic form. It's already a very powerful tool to learn about the big picture, the big bias of the market. Okay, so for those who weren't with us in the past 2 weeks, just a quick recap. We were saying that there's no difference between the very primitive, the very basic markets and the very sophisticated stocks market or financial markets. But both markets need to have a seller willing to sell at a certain price to a buyer that's willing to pay the same price. It's the same thing that happened in both markets, the most basic and primitive one, and the most sophisticated one. It's what makes it. And every price that is determined in the market, it's a trade that happens. Somebody sold a commodity to somebody who paid to buy that commodity. If that wasn't happening, then we didn't have a price, then the chart wouldn't be printed on that price level. There wasn't any tick. So it's pretty much the same. And whatever and price direction is determined by if there are people willing to buy or to sell the commodity. So we were discussing three scenarios. In this slide, we see only two scenarios. One is that there is a high demand for a specific commodity with low supply, which means that price can go up, and we usually being used to where we go to places like we see on the right side where there's only one licensed business that is allowed to sell commodities. Usually the price when you go to a concert or to a festival, usually the price there are higher. While if you go into that neighborhood and there are not many people willing to buy this lemonade from these two cute girls, they would sell it for much less because they just want to get rid or to eliminate their possible losses. So and we're trying to illustrate what's really going on in the under the hood in the market central, in the market exchange. How does it look? So the best way to illustrate it is by two drawers, one for sell orders and one for buy orders. And we can see just each paper represent a demand for one unit, one contract of whatever equity it is, and this is and we can see if there's a pile much bigger, the market exchange responsibilities to match between the buyers and the sellers, and when in this case the sell orders will get all their buyers, and this sell orders drawer will be empty, there will still be more orders for the buyers. There will still be demand and no sellers at that point. So the exchange would raise the price and look for new sellers willing to sell at higher price because they're not willing to sell at that cheap anymore. So price will go up. So that's the very automatic logic and mechanism that drive price up or down. And by understanding that and by illustrating this picture in our mind, we can go to the chart and understand why is price going up and down. And this is actually what we're going to look when we go to the charts. So what are we looking for? We're looking for places on the chart where we assume that there are unfilled orders waiting, meaning that these stacks of contracts waiting in the drawer are waiting for price to come back, and these orders will create a high probability of price reaction. So how do we see it on the charts? We're going to define a zone, which, one second. We're going to define a zone that will show us two barriers, the upper and the lower. The lower barrier in the case of a demand zone will be the lowest trade that ever happened. We call it where was the worst seller, where was the person that sold at the cheapest price to the luckiest buyer. And then we're going to look for where was the last significant seller before a significant rally, and then we're going to define the collective decision point. The collective decision point is where the the democratic decision of the whole market participant, that actually from that on price was shooting up. So we're looking for that decision point, and this will determine the higher barrier of that zone. And once we have the decision point and the most extreme line, then we have the zone which already define our trade. Our trade will be entry at the decision point, and our risk, our stop loss, will be beyond the furthest position. I see some people leaving because. Do you see the do you see the slides moving? Because some people say it's not. Yes, it is. Okay, I'm sorry. Okay, so it's just a recap. So be patient. We're going to get into new stuff very soon. Okay. So same thing for supply. Supply zone is determined by the very same way. We look for where we have the worst buyer, and that will define the upper barrier. We're going to look for where we saw the last buyer before a significant drop, which will be that line. And then we're going to look for the collective decision point, which will be our short entry point. This will determine our risk area, and stop loss will be beyond this point. So just by defining a supply and demand zone, we already have a trading plan waiting for us to apply. So it's a great thing because we can calculate how much we want to risk on a zone before the trade had happened. We understand the price section, we understand the price possible range, and we can recalculate the position sign according to this. We are waiting for price to come to our zone instead of us chasing price events, impulsive price events. We know what's going on, and we have a pre-planned action to apply, and it's put us in a whole different dynamic while trading. So these are a few of the things that why I like this this concept. So the way I read the market is I look at the market and I just see order flow. I see where are possible remaining orders that are waiting to be applied when price will come back. We discussed that there are three order flow situation. We have a balanced situation where price is ranging, is not deciding to go on any impulsive, and when there are an impulse to any direction, it means that one side is on top on the other. In that case, we have a decision for price to rally. It means that there are more buy orders than sell orders, meaning that on that decision, price probably will fill these remaining orders when price is coming back. So this explains all the zigzags, all the stops that you have in a rally where price decides to retrace. It being explained by the order flow. Juan is asking, how do I know where there are more buyers and sellers in orders to know if it is time to buy or sell? If you were in the past sessions, we explained this, but it's the same thing like the draw illustration, where the participants of the market decide to rally or to drop in a place, we assume that there are leftovers orders, and we're going to use it only once, only on the first price revisit at that line. So what I explained in the slide before, we're going to wait at the decision line, at the decision point or decision level, only for the first time that price will visit that line, and there we can expect some sort of reaction. It's not always going to be a reversal, but it's a reaction. Okay, so it can be the beginning of a retracement or just a stop in the action and then return to the same direction, or it can also be a reversal. Okay. There are no indicators to show this. You can create ones, but they're not very accurate. And I personally recommend that nobody will look for shortcuts and indicators before you really know how to read it yourself. Okay. Okay, so we also discussed that order flow is everywhere, meaning it's not only on the top, it's also at the mid-range and on the retracement. Every time that price is ranging and then impulse into a certain direction, we assume that order flow is waiting there. But we have to understand that in the mid-range events, we have to consider the context of the trend in order to not put ourselves into unnecessary risks. Okay, so there are orders that explain bounces and explain reaction in the market, but they're not necessarily going to give you a bonanza trade. Okay, but it explains, it's a price action that give you a lot of logic what happened in price, why is price behaving that way. Okay, so these are supply zones inside the range, and there's also demand zones that's being created while in the mid-range, and we can see that in most area price is reacting to these zones. It's only a reaction, not a reversal, not until we go to the very last event where the reaction is much harder at the extremes. Okay, so let's start talking about a new concept which we call a swap zones. You know, the market is all about respecting and not respecting levels, right? If price would be always respecting levels, then there wasn't any secret to the market. Everything would be too obvious and nothing would be making sense anymore. So levels and zones are made to be broken, and we need to understand the dynamic and the anatomy of this break. We were saying that when price first return to a decision line, we assume, and I specifically say assume because we don't know anything, we just can assume that price will be reacting in some way to the remaining order flow that we assume that they are there. This is why our concept, our trading plan, telling us that we are going to do it only at the first visit and not more than that. And we can see that in that simulation we have we have a context of an uptrend, and you see that on the decision point, price is being reacted, but not really reversing. You see this pattern all over the market, in any market, you name it, in stocks, in commodities, in forex, in futures, whatever. Okay, it's just the very core anatomy of how the market works, because it reacts to the balance of orders, if there exist or not. Okay, and then when after price being testing the level, what happened? It takes the remaining orders, and when the remaining orders pile is getting lower and lower, it's suddenly not being there anymore, and then price is ready to go up and break the level. Okay, so this explains why a level will be break, and this is also explain why us as a traders, we only want to take the first touch and not the second and not the third, because after the first touch we cannot assume and how much orders are left there anymore. And Juan is asking if there's a specific time frame for that. There's no time frame in the market. The market doesn't work by time frame. Time frame is artificial way to write the market, but there's no price doesn't move by by time frame. So try to not think about time frame. It's all about price levels, and you see these price levels, you can see them on 1 hour or on daily, and on 1 minute it's the same price. Okay, so I want to show you on the market itself how things work. Okay, so this is a euro dollar, the latest 1 hour chart, and while we okay, so when price is rally on a way down, like we said, it's creating decisions that that breaking other levels. And if we see this demand zone and price is coming back to that demand, when price is breaking that zone, it's become a resistance. If you know the concept of support and resistance lines, it's pretty much the same, but this explains it, because because when we try to see things in visualizing the order flow that is waiting in the exchange. Okay, so when a decision made on that line and price was breaking it, it was consuming all the buy orders here, and in order to consume all the buy orders, somebody had to push and to inject more sales orders into that place, because there are remaining orders of remaining buy orders. There was a need to inject more effort in selling in order to break this zone. Okay, considering it is a zone. So what happened? It's like when you drill into a wall with your electric drillers. You drill hard and you press with your hand, and then suddenly it just pushed into the wall very hard. Do you know that feeling? So it's pretty much the same thing with the market. When you want to fight the resisting force with what you have, you bring more orders, more sales orders into the market in order to win the opposing force. In that case, it's the buyer's forces, and you bring more sellers, and suddenly there's no resistance anymore, and nobody, even the most sophisticated players in the market, they don't really know how much orders are waiting there. So what they do, they just inject more and more and more and more until it breaks. And when it breaks, what happened here? It's a decision to sell. It's a decision for price to go down. So when price is coming back, it's become a supply zone. So you see, we had a demand zone. It was broken, and when it was broken, on the very accurate peep point, it became a supply. So if you were a support resistance trader, you would put a line here and you say support become a resistance. Okay, so it's pretty much the same theory, but we have an explanation in terms of order flow, in terms of what motivates the market, and now we understand how it works in the dynamic of the orders that's in the market. So we can see, so we call this event, we call it a swap zone, and we can see it all over the market. If we have here a demand, and this demand was broken, and then it was resistant. It's not the greatest example, but I've created a few examples before. We have this one. Oh yeah, on that euro yen. Okay, we have this decision that's going to react later on. Okay. Okay, so we have here a demand. It was eaten, consumed a long time, and then when it was broken, it reacted as a supply. We see it over and over. Here's a demand, and here it becomes a supply, and it was broken again as it turned back to be a demand, and then respected as a demand. And so and it goes on and on and on, and it's also, this is how we explain trend building. So so to, oh yeah, I forgot I did this illustration for you. So let's get back to the illustration. So we have a zone created, and the order flow would be that there are more demand than supply, meaning that the exchange now will match all the limited supply against a very high demand orders. So if we just do the net calculation, we'll have these order will be leftovers for when price will come back at the next time. Okay, then price go up and print it, and was printing a supply zone, and a supply zone is where you have more supply orders than demand, and so the exchange will match this trade, and whatever supply will be there will be leftovers for the next time to come and visit. Okay, so then price become, remember we have less demand in there but not enough supply, so price will net and stay and consume a little, and then price will go up. Price will balance a little bit, so it will be ranging, and then more people will come to buy the assets, the equity, and then price will be consuming all the leftovers which were waiting here. It didn't create a reversal, but it consumed the leftovers orders, and price is breaking the zone, and this zone that was once before a supply zone is becoming a demand zone afterward, because when like I explained before, when we want to break a supply, we inject more of the opposing force, and we don't really know how much. So when there is a decision to break, that decision is creating the same assumption of order flow, unfilled orders waiting. So that decision is turning that supply zone into a demand. Rogers, you may ask your question, write it down, and I'll try to answer. Okay, so in the charts, you can see supply that a demand, a supply zone that was broken become a demand at one time. We can also see a supply here that once it was broken, it become a demand. Again, now a demand that was broken become a supply, and then when it was broken again, it continued to be supply in that case. So we see it over and over: a demand becoming a supply, and then broken. Okay, so this is how the swap zone dynamic, and this is what explains breaking of the levels. Levels and zones need to be break in order for the market to function. So just remember that, and that will give you the rule of thumb that whenever you want to trade a supply and demand zone, you will do it only on the first visit and expect only a reaction, not a reversal. And for the next visits on the same level, you will have to be very, very cautious, because we don't know how much really unfilled orders are in there, and the zone is assumed to be break. It's a breakable zone at that moment. So keep it in mind when you planning your trade. So now let's talk about a new concept that we call compression, and be ready to answer some of my questions. We'll do a quiz. We see this situation, and please write me down, what do you think will happen with price? Will price here on the, we see an impulse going up and then price is ranging. What will happen next with price? Will it go up or down? And how far can it go up or down? Do we have any clues? Do we have any idea what can happen next? Anyone? Price will go up or down? Okay. Juan says if you think it's going to reverse. Why it's going to reverse? Market is developed. We don't know the future. Will go down. Price should go higher. Like going down. Flag pattern. Down. Okay. Up. Okay. So let's try to read what's going on here in terms of order flow. Okay, we said that for every decision that happened in the market, every impulse is a decision that we can write a decision, and on this decision we have unfilled orders, and we also have this this work plan that telling us that when price visits that level afterward the first time, after that first time, we assume that there are no filled orders anymore. It's being consumed. We don't know how much is left there. So when we see a price action that for every decision price is coming back to that decision, we assume that on that decision point there are no more enough unfilled orders to hold price in the next time. So we see price going up and coming to take the decision. We see price going up and taking the decisions. We see price going up and taking the unfilled orders flow. And we see decision and price is already taking the order. So this whole zone has no demand anymore. We assume there's no demand anymore. So in this ranging, in this flag situation, like somebody mentioned, price is really have no strength to hold price. So if price will try to go through here, it will easily penetrate here, the whole area here, the whole price action zone, because there are no demand to hold it. We call this situation a compression, and what's beautiful in it is that when this situation is building along very, very long time, you see how many candles it takes to build this situation. Every slight accomplishment of price going up, it's coming down to take the orders. It's taking the orders all the time. So when price is going down, there's really nothing, no strength to hold this price, and this whole zone that was taking like 40 or 50 candles was just taking by 3 candles. Okay, the whole zone, and then it also took a few more to go even lower. Okay, so that's pretty much powerful concept that we can understand only by visualizing what's going on with the unfilled orders and the first and just seeing that the decision was already taken. So we so it's a very simple concept that telling us that if price was visiting a decision zone, after that there are no orders. This is what we assume. This is our work plan. Okay, and by that we have a whole zone that giving us a clue that there's not going to be a force to hold price, at least on that area. Okay, so here's a similar situation. Here's another compression situation. Look how price is crawling up. It's all, if you've been a trend trader, you would say, okay, price is making higher lows and higher high, higher lows and higher high. But if you're an order flow analyst, you look where price went, okay, and where price turned up. And what we see here, we see a decision to go impulse and make higher high, and then price going down and take that decision. And then here's another decision, price going up, and then come back to take the decision. And here's another decision, and price going up, making higher high, and then going and take the unfilled orders. And here's another decision, and making higher high, and price going and take the decision. So we have no orders. And if we go to lower time frame, we can see these events more clear. And so this is a demand, and price is being taking the demand zone, and again and again and again. So we call this area a compression zone. Okay, so this compressed zone, if we going to look what's going on later on, price will just shoot down because nothing, there are no buyers. All the buyers were already taking in early stages, and now this whole zone is just free to drop like a falling knife. Okay, and then once price were going down on a compression, the thing that will stop them, stop price, is another unfilled zone that you can find on your left history. And we can see that the consumption of a compression will bring price to take a lower demand, and from that on it can go up. So when you see a flagging situation like this, when you see a compression building up, it doesn't necessarily mean that price will go beyond the compression. So the way that we're going to trade this is we're going to trade only the zone that was created by a compression, and we will not ask to take more of our trade. We'll put our take profit around here, which is the last unfilled order that we've seen. It's being faked out probably because something on the left, but this is how we play safe. We know we can trade only what we know and only what we understand. We're going to trade only where we see significant force of unfilled orders against no orders waiting, against a compression zone which has no orders. So that's our potential trade. We're not going to take more than that. And after that, this is the just to show you that price just took the potential of the compression and then continue the rally up. Okay, so be aware that can be happening. Okay, here's a compression on the other way around. Supply is building up, and for every supply, price come back and take it, and after the first one, we assume there are no orders anymore, and again and again and again and again. So the whole zone here is compressed, and when price penetrate this zone, we assume that there are no sellers in this area, so we can just mark this. Let me just draw this. Okay, up. I showed you. Okay, we have this decision that was not taken, and so our trade will be only up to here. Okay, eventually it go higher, but from that picture we don't have enough information. But this whole compression zone, this is our potential. We see how price been taken, the orders all the time. Orders are taken, orders are taken, orders are taken, meaning there's no sellers in this area, so price is ready to shoot up. And just look at the potential. If you were in a sell trade because you're a trend follower and you see price going down and you're hopping on the train and you're going and you're going down the trend, you're going to be exhausted on this situation. Price will go up and against you all the time, and you're shorting, and it's just for every little step it makes, it goes very deep against you. You're going to be exhausted. But if you see as a order flow analyst, you see it's a compression building, you know how to stay away from a short here, and you're going to look for a short-term buy opportunity to at least this level. Okay, so that's the power of understanding and reading the order flow and the consumption of the order flow, and that is implied order flow. Okay, we think and we understand how the mechanism work under the hood, and with that we can decide better and wiser how we stay away from trouble and how we take more opportunity. And while the short trader is suffering for a very, very long time, you'll be patiently waiting on the fence and taking your opportunity, and you will be making all the suffering of the short trader in very few candles. And that's what's beautiful about this. Okay, so how do we trade a compression? If you look at this chart, you can see there are a lot of compressions. There are a lot of compression in this chart. For if you're not reading charts very well, for many it's going to look like a random thing. But for an order flow or supply demand traders, you can see a lot of opportunities in here, and it's almost been everywhere. Every time you see a condensed price crawling up or down, you can already assume there is a compression there. You have to look deeper and see that price is really taking the levels and taking the decisions, because sometimes it can be a trick. You can see, if you look carefully, you see that the levels weren't really taking, so you have to be careful for that. But if we look at this chart and we're just looking for a compression, we can see them everywhere. Here's a compression. Price is taking all the demands, and then when price is hitting a supply, then it just dropped like crazy. So that really defines what we're trying to do. So look how simple would be that trade without understanding. We have a bigger picture. We have a context of price falling down. Okay, we have a mid-range decision to go down. So that's defined a supply. Meanwhile, price is being held and being crawling up, creating uh, creating demands and consume the demands very, very early, meaning that it's creating a compression, meaning that we have no demands, no buyers left in this area. So our trade is defined very, very easy. We're going to sell a fresh supply, untouched supply, which has a big significance because it's never been taken before, so we assume there are unfilled orders in there. It's also the context of the rally, of the trend, right? And we have a demand which is being consumed, a compressed demand. So we're going to trade against these buyers with all this information. So where are we going to take our trade? On a fresh supply. So we're waiting here for how long it's going to take. We put our stop loss above the zone, and we enter, and pretty much on a very accurate way, it just after it's being exhausting all the buyers that thinking that it's worthwhile to buy, you're going to take a very, very nice slide across the compressed zone, and it's going to be easy, and then you can return back to the trend direction. So that's one example. Another example is here against the context of the trend, but we have here a compressed supply, meaning that we're going to look for a demand, which we can find it here. We have a decision here for a demand, and we see price is being compressed on the seller's side. So we want to buy at demand and buy at least all the way up to the end of the zone. And this one is pretty much tricky. If we would plan our trade, we would want to buy it around here and take profit around here, because this supply wasn't really taking, even though price was up. We still don't have the enough information to know that price can go above this area. So that's the last place where we should have take our profit. So we have a demand. We're going to buy demand. We'll have a slight drawdown at the zone, and then price will very soon go all the way up to our take profit around here. Okay, here's another compression, and here's another demand. So we're going to buy a demand against a compression, and we're going to take our profit. So see how many trades we have. Here's a very tiny compression, and if we want to take it on that supply that was freshly printed, we would enter around here, not being really sure about our trade for a while, but then it's going to drop. Our take profit will be here, but we also have a bigger potential because the whole area here is already compressed as well. So it could be a good opportunity to go and take a short. Okay, so here's another compression. So it's full of many events are going there, are happening with compression. Actually, every flag, every pole and flag, if you know this terminology, is actually an impulse with a decision, and then most of the time it's a compression. So this is again explain you a generic terminology that you probably learned before, but now it's suddenly explained with how the market really operates. Okay, so now you have the explanation why it's being acting the way it is. Okay, so to illustrate what's going on in a compression, that would be the simple way to look at it. Price is being impulsed and creating a supply zone, and price is being and there's a decision to go down, and then price starts crawling up. It's creating higher high and lower and higher lows, higher high and higher lows. So if you're being if you don't really understand and you're a trend trader, then you would probably be tempted to buy this. But you see that this crawling up is a compression building, and what would you like to do? You would wait for the fresh supply, take a short in here, and waiting to drop down on all these little supplies, little demands that were already taken, and show you the way beforehand. So this is compression, and before we finish, I would like to give you another insight of the market, which is very, very important. It's mostly related to understanding the big picture. We are, as a retail traders, or even if we have I don't know, $200,000 account, it's we don't really influence the market. There are bigger players that they have different set of rules and tools to work in the market. When they put their orders, they actually influence the order flow. And when they decide to take action in the market, let's say to play long or to play short, they have to play in a different way. While we, as a retail trader, when we decide to buy an equity, we just go and ask from the market the amount of units that we want, and we most of the time we get it. But when a huge hedge fund with billions of dollars invested in an asset wants to do it, they cannot do it, because they if they inject these requests from the market, they would be revealed so easily, and price will just play against them, and they will just sell their commodities for very, very cheap. So they should do it in a very tactical way to disguise what they are doing and what their intentions are. They really have to do it in a very, very tricky ways. But if we learn the right ways to look at the market, we can see them entering the market, and we can really smell and feel their intentions. So let's just imagine a huge hedge fund wanting to sell, and let's imagine that this is an Apple stock chart, okay? And let's say this hedge fund is having a short position on Apple stock, and around the blue dotted line, they want to buy it. And this hedge fund is they manage billions of dollars, and a lot of them are invested in this big firm, Apple, and they want to now take the shorts and make them long orders. And another thing we must understand about hedge funds, that this is their job. They really have to invest the money. Their money cannot stay at the bank because people are relying on this income. People that the ingredient that they put in the machine is money. So money cannot stay at the bank. Money must be invested in the market at all times. Either it's on a long or on a short. If it's $1 billion position, $1 billion position must be bought in order to exit a short position, and then buy again into exposure, into holding the asset. Do you follow what I'm saying? When this hedge fund is now holding short positions, they're actually being exposed to the market. So they holding short contracts, and while they deciding to buy long contracts, they have to get rid of the short contracts, and then afterwards they will have to buy again long contracts. That means that they're doing the same thing twice. If that's $1 billion position, then they make $2 billion in transaction. Once they make buy orders in order to get rid of the short contracts. The second time, they make buy orders in order to buy long contracts. Okay? Am I being more clear now? So they inject huge amount of orders into the market, and they cannot put it at once. So they will put it in chunks. They will start to slow down and get rid of their contracts at early stages, and try to make it as silent as possible. And then once they manage to get rid of all their short contracts, now they have to do the opposite way, and they have to silently do pretty much the same, but now to hold long positions and not getting rid of short position. So they're doing actually the same. So if we see a past event, we cannot see it, we cannot determine it, let's say here on that timeline, on that position on the timeline. But when we see event like this, okay, we can assume, and mostly on the long time frame and for very major equities, very big equities. When we see this, we know that the big players of the market are being involved. They probably sold their short positions and got equipped with long contracts. So we can be assured that it's not going to be very easy for them to change their mind, and they will put a lot of effort in order to push the market, and they do have the force for that. They do have all the the tools for that, because they can influence the market to continue and to make their investment a profitable one. Okay, so they will trick and do everything in order to push the market up. And when you see that, who would you want to trade with? Would you want to trade against what they're doing? When you see that, you understand it's a real reversal with a big um, player that show his interest, show his bias to us, and we will not want to play against him. So exactly, Ed. We going to trade with the big money, with the big fish. So if you want to learn more about understanding the big trader and the anatomy of this reversal, please refer to and do a Google search. There's a lot of information about this under the keywords called Wyckoff. Wyckoff is a trader from the 20s of the 20th century, and he investigated and created this this theory, and he really and it's still working until today. Sometimes dynamic are slightly changed in here, but because the market always being worked by order flow, you cannot escape the truth of that, and the pattern is there all the time from the very early times in the market exchange. It's you see, it's a study he did in the 1920s, and it's still valid today. So just search Wyckoff and learn about this. Maybe we can I can show you on Google, because this is the end of our presentation today. Wyckoff theory. Oops. Okay. Search for Richard Wyckoff and learn about his study, and you can see and learn how to realize that big players are entering the market, and trust me, you want to be trading with their side. Okay, so so that's the end for today, and I want to thank you a lot for showing up. Next week we're going to have the fourth session, and we're going to take and we're going to discuss. We're going to wrap a few of the concepts that we're talking about. We're also going to mention fake outs, what's happening in fake outs, and how we can take advantage of fake out events and to trade into our favor. Actually, this is my favorite way of trading, trading fake outs, and we'll understand it by the dynamic of the order flow, and we'll learn how to trade them. And I will also did a cheat sheet that I will show you next week for anyone that is wanting to trade by these concepts. I created a cheating sheet that will help you to grade the situation on the charts that you analyze, and with that you can create your bigger trading plan and be more precise and more accurate and more disciplined in the way that you decide how to enter or exit the market. So I really hope that you will come next week at the same time, at the same place, not at the same link. So make sure you sign up at investing.com. This session, like all other sessions, are being recorded and going to be shown on investing.com and also on the Fiverr's YouTube channel. And so you can watch it for later. I'm available for any questions if you want, and you can write me and you can Skype us. And I really, really want to ask you to take a visit into our website, see if any of the opportunities that we're offering are good for you or for traders that you might know. And if you refer us traders, we will be very happy to reward you most immediately. And thank you so much, and have a great evening and good karma. Good night.